Swiss Credit, which was on the brink of bankruptcy, ultimately found a buyer and was acquired by UBS Group for 3 billion Swiss francs, approximately $32 billion US dollars. This price is extremely cheap, given that Swiss Credit has been experiencing frequent setbacks and rapid decline in recent years. However, by the end of 2022, Swiss Credit's total assets still amounted to $574.3 billion, and its managed assets reached $13.8 trillion. Therefore, UBS's acquisition of Swiss Credit at a price of $32 billion was very low. But even at such a low price, UBS was still reluctant to make the acquisition. If it weren't for the Swiss National Bank's extremely generous bailout, UBS probably wouldn't have wanted to take over Swiss Credit. Although Swiss Credit's total assets seem large, a run on the bank had occurred. If UBS had not taken action, Swiss Credit would have had a high probability of bankruptcy. Therefore, the fact that it was acquired for such a low price of $32 billion also indicates that Swiss Credit was already on the brink of bankruptcy. If UBS had not acquired it, once Swiss Credit went bankrupt, it would have been worthless and would have become a liability. UBS estimated that the losses from the acquisition could reach $5.4 billion, and this is only the direct loss, with the long-term losses being incalculable. Although UBS is a big and established institution, there is some doubt as to whether it will be dragged down by Swiss Credit. To put it simply, if it weren't for the Swiss National Bank's massive bailout, Swiss Credit would have been given away for free and nobody would have wanted it. Swiss Credit also fully illustrates what it means to be too big to fail. The Swiss National Bank and the Swiss government have risked their reputation to save Swiss Credit. Let's take a closer look. After Credit Suisse was acquired by UBS, on March 19, the Swiss government announced that it would provide up to 9 billion Swiss francs in loss guarantees to help UBS take over Credit Suisse's assets. If Credit Suisse's investment portfolio incurs losses, UBS will bear the first 5 billion in losses, and the Swiss government will bear the subsequent 9 billion in losses. If there are further losses exceeding 14 billion, then UBS will have to bear them on its own. The Swiss government is providing UBS with a shot in the arm, otherwise, UBS probably wouldn't dare to acquire Credit Suisse. Additionally, in order to complete this emergency acquisition, the Swiss side has also taken many unconventional actions, blatantly plundering Credit Suisse's major shareholders and bondholders. Firstly, this deal bypassed the shareholders' meeting, meaning that the acquisition was made without the consent of Credit Suisse's shareholders. The announcement showed that UBS had obtained pre-approval from the US Financial Management Bureau, the Swiss National Bank, and the Swiss Ministry of Finance to quickly approve the deal, bypassing the shareholder approval process. Therefore, for Credit Suisse's shareholders, UBS's low-priced acquisition also means a huge loss. In the 2-year continuous downturn, Credit Suisse's stock price has fallen from $14.95 to just $2, almost 3 consecutive times of cutting in half. But even with such a huge drop, as of last Friday's closing price, Credit Suisse still had a market capitalization of $7.922 billion. The final acquisition price was $3.2 billion, which was a 60% discount from last Friday's closing price. As a result, Credit Suisse's pre-market trading plummeted by 60% after the acquisition news was announced. The biggest loser in this deal is Saudi Arabia. Rumors of Credit Suisse's bankruptcy had already surfaced in October of last year, and it was Saudi Arabia that helped keep Credit Suisse afloat for another 6 months. In November of last year, the Saudi National Bank invested $1.5 billion in Credit Suisse at a price of about $4 per share, acquiring a 10% stake in the bank and becoming its largest shareholder. According to the acquisition price this time, which is about 81 cents per share, Saudi Arabia lost 80% of its investment, investing $1.5 billion in Credit Suisse and losing $1.2 billion. In addition, UBS's acquisition of Credit Suisse was not done with cash, but with a stock-for-stock swap. Credit Suisse shareholders holding 22.48 shares of Credit Suisse stock will receive 1 share of UBS stock. This means that UBS can buy Credit Suisse without spending a penny, just by issuing shares. And large shareholders like Saudi Arabia cannot easily cash out after exchanging their Credit Suisse shares for UBS shares. Because they hold too many shares, if they sell them in the market, it will cause a sharp drop in UBS's stock price, which will further increase their losses. Therefore, after the news of the acquisition was announced today, UBS's stock price also plummeted, dropping as much as 16% at one point before narrowing to 4%. And the ones who suffered the most were not the Saudis, but the holders of Credit Suisse's AT1 bonds. To strengthen Credit Suisse's capital and give more confidence to the acquisition by Credit Suisse, the Swiss government announced that the additional Tier 1 capital bonds, aka AT1 bonds, with a nominal total amount of approximately $17.2 billion held by Credit Suisse would be written down to zero. In other words, the investors of the $17.2 billion AT1 bonds would get nothing back. In a typical bankruptcy procedure, the repayment priority of stocks is lower than that of bonds. However, due to the Swiss government's intervention, Credit Suisse's AT1 bondholders were left with nothing. While Credit Suisse's shareholders could still receive $3.23 billion, albeit in the form of shares. Therefore, the feeling I get from this Credit Suisse acquisition by Credit Suisse is that Switzerland, in order to maintain its too-big-to-fail banking framework, has shamelessly looted the shareholders and bond investors of Credit Suisse. By doing so, they strengthened UBS's confidence in the acquisition. AT1 bonds are a type of subordinated debt that shifts bank risk onto investors, but investors can receive higher returns in return. This means that if the bank is fine, AT1 bond investors can have higher returns, but if the bank gets into trouble, AT1 bonds can be written down. From a design perspective, AT1 bonds are high-risk, high-return products. However, it was a bit too extreme for Switzerland to write down the entire $17.2 billion of Credit Suisse's AT1 bonds to zero. The most crucial point is that Credit Suisse has not announced bankruptcy yet, so the Swiss government's move to write down the $17.2 billion AT1 bonds is problematic from a procedural standpoint. Of course, Switzerland claims that there is no legal issue here. When a bank is deemed not viable, its AT1 bonds can be written down to zero. This determination is made by the National Regulatory Agency. The Swiss Financial Market Supervisory Authority stated that its decision upheld the country's too-big-to-fail banking framework. In other words, Credit Suisse was essentially acquired as if it were going bankrupt. However, in a typical bankruptcy, bondholders have priority over shareholders. Usually, after a company declares bankruptcy, shareholders suffer losses before bond investors. This is why the process this time seems flawed, as Credit Suisse did not actually go bankrupt, but was acquired. Switzerland treated the bonds as if they were written down to zero in a bankruptcy, following the acquisition process. Clearly, this raises some issues. In order to avoid declaring Credit Suisse bankrupt, Switzerland decided to use acquisition as a way to deal with the problem. However, in order to make the acquisition happen, they adopted a method similar to bankruptcy. Despite this, Switzerland still refused to admit that Credit Suisse had gone bankrupt, which led to this problem. This approach by Switzerland has caused panic among bond investors. After the subprime mortgage crisis in 2008, especially after the European debt crisis broke out in 2010, European banks issued a large number of AT1 bonds to get through the difficult times. Later, due to the 10-year quantitative easing policy implemented by Europe and the United States, the European banking industry as a whole also recovered, and AT1 bonds became a hot commodity. As a result, AT1 bondholders almost forgot that if a bank goes bankrupt, the AT1 bonds could be written off. Therefore, the move by UBS immediately caused a plunge in the European banking industry's AT1 bonds. As a result, Asian bank AT1 bonds also plummeted, with the hardest hit being the East Asia Bank's $650 million AT1 bonds, which fell by 10%. This is quite a large decline for bonds, and AT1 bonds of other Asian banks also fell by 2% to 6%. Overall, UBS not only bypassed Credit Suisse shareholders but also wrote off $17.2 billion AT1 bonds, which is quite outrageous. Let's review the situation again. After Silicon Valley Bank went bankrupt, investors immediately lost confidence in Credit Suisse and caused a sharp drop in its stock price, as well as a continuous crisis of withdrawals. This put Credit Suisse, which was already in a precarious situation, on the brink of bankruptcy. Unlike Silicon Valley Bank, which was just a regional bank in the United States with a sizable asset scale of $200 billion, mainly serving startup companies in Silicon Valley with limited influence. The reason why Silicon Valley Bank had such a large destructive power, forcing the Federal Reserve to urgently print $297 billion to provide targeted liquidity to the U.S. banking industry, was not an exception but a widespread problem in the U.S. banking industry, with as many as 186 banks having similar operational risks. However, even so, the scale and influence of Silicon Valley Bank cannot be compared to Credit Suisse. Before the subprime crisis broke out in 2008, Credit Suisse was one of the top 5 financial groups in the world. Although it was severely hit by the subprime crisis, which made Credit Suisse downhill for many years, in recent 3 years, Credit Suisse has repeatedly stepped on mines. The Archegos blow-up, Greensill bankruptcy, and leaks have all caused huge losses to Credit Suisse. But a skinny camel is still bigger than a horse, and Credit Suisse still manages trillions of dollars of wealth and is a multinational financial behemoth. Once Credit Suisse goes bankrupt, the chain reaction and crisis scale it will cause will be much greater than that of Silicon Valley Bank. This is why the Swiss National Bank is working so hard to save Credit Suisse. On March 15, Credit Suisse, who had been stubbornly refusing assistance, finally began seeking help from the Swiss government. Soon after, on March 16, the Swiss National Bank announced an emergency loan of 50 billion Swiss francs to Credit Suisse. However, this did not prevent customers from withdrawing their deposits, and Credit Suisse's outflow of funds still exceeded 10 billion francs per day. As a last resort, the Swiss government and the Swiss National Bank began pushing UBS to acquire Credit Suisse. At first, UBS offered $1 billion, but Credit Suisse resisted. On March 18, it was even rumored that Credit Suisse might be fully or partially nationalized as the only viable option outside of UBS acquiring the company. Of course, this was the last resort for Switzerland. To increase confidence in UBS's acquisition, the Swiss government bypassed shareholders and wrote off $17.2 billion of AT1 bonds to zero. In addition, the Swiss National Bank announced that Credit Suisse and UBS could receive up to 100 billion Swiss francs in privileged creditor status liquidity assistance loans in the event of bankruptcy. Furthermore, the Swiss National Bank could provide Credit Suisse with up to 100 billion Swiss francs in liquidity assistance loans and provide federal default guarantees. Ultimately, with this series of strong market rescue measures, UBS reluctantly proceeded with the acquisition of Credit Suisse. Actually, UBS should have been well aware that many of the assets of Credit Suisse were toxic. The foundation of Switzerland's banking industry is based on two legs: a banking framework that is too big to fail, and Switzerland's special status as a neutral country. However, during the Russia-Ukraine conflict, Switzerland abandoned its neutral status and chose to follow the United States by freezing Russian assets. This has greatly damaged the reputation of Switzerland's banking industry. Therefore, this time Switzerland is risking a collapse of its reputation in order to prevent Credit Suisse from collapsing. But the fact that this acquisition is basically being carried out in a way that resembles bankruptcy indicates that Switzerland's too-big-to-fail policy has already failed. Both legs of Switzerland's banking industry have been broken,